The banks have financialized it. Just like gold, they've created all this synthetic Bitcoin now, whether it's in futures contracts or ETFs or all that stuff. So wait a second, now all of a sudden it's trading like gold, where it's capped and managed. That's a shocking development.
Yeah, and I mean, I hear you. I mean, that's great analysis as well. And I'm glad that people can come and get that from you on a day-to-day basis as well. It's very important that people understand what's going on. When you're sitting there making decisions, there's 1,000 inputs. It's you need to really distill it down to, well, yeah, but actually, what does that translate into? What do I do? Whether I'm a stacker, that's easy actually, a stacker. I mean, you know very well that any dip is worth buying, but then obviously there's a lot of people make a living out of this. So it's important. And I think, so there's some really interesting stuff going on at the moment. I think the one of the interesting things, and I talked about this in my last episode, in fact, we broke that news. We had this letter from Argo Horaeus, and it said, oh, by the way, we've got an Omicron. Oh, shortage of staff. No, we're not. We can't produce. Be aware that we won't be able to fill your orders to the degree you want them. And guess what? You want any silver? Forget it. We've shut that down completely. It is dry. Obviously, we're using any resources we have to produce gold at a far lesser rate. Now, what happened? What happened the last time? And this is the first time, actually, since March 2020, that we've had, okay, it was slightly different because the refineries were shut down then. But what happened was the exchange for physical, this COMEX translation, this paper price, translates over to the through this EFP conduit simply. In other words, it converts into a spot contract, an FX contract, which is actually how you price gold at the FEXs, which we've just been through. So here's the problem, is that when you see that price get crystallized and you can actually take delivery, what happens is the liquidity provider that is providing that long, suddenly you turn around and you go, okay, well, actually, you know what? I'll tell you what, I'll take delivery of that. Thank you very much, because I can't get it anywhere else. And suddenly, all of a sudden, what happened was, well, yeah, but we don't have the physical. So we need to cover that position. The liquidity providers bail. They all disappear. Liquidity vanishes. And now it's costing you $80 to $100 to buy back a short position that you hedged with a paper got long gold position. So, okay, I know that Basel III is slowly bringing the banks compliant. They are coming to be compliant because literally they lost a lot of money. A lot of these banks, European, Swiss banks, pulled out of that business altogether. And in fact, they even pulled out of the third-party custody business, which is so profitable. They just didn't want anything to do with it. Compliance said no. So you've got this effect where, yes, the Bank of International Settlements can create unallocated contracts. They can throw them into the COMEX, but you don't have the banks joining in with them anymore. And it's an interesting, subtle difference. It's very subtle, but it's coming. And in fact, you mentioned silver and you mentioned commodities. All commodities are going to be NSFR compliant ultimately. They have to be, because again, it's about compliance. It's about these banks are on the hook. Now, gold, obviously, the officials, as we call them, the central bank of central bank, the Fed, yeah, they have an interest in capping gold. But they don't have an interest in capping anything else. And really, it's about competition of gold and the dollar. So it's an interesting dynamic at this point, because we see that the agent banks starting to pull away. We still see the need to cap gold. It's happening, and we see that. We see it in options expiry. We're seeing a spike higher to $10. You see it coming right back down. We see a capping at 1850. Why is that? It's because on Monday, Bank of International Settlements really wants it around 1830-ish. But what's happening is that we're now seeing this AFP situation, because the refiners are now no longer producing the kind of volume that makes a liquidity provider comfortable. And the liquidity providers are, in general, having to back their long positions with physical, which makes it very difficult. So that means a short position on the COMEX, when it's hedged with an over-the-counter position, unless it's actually held by the Bank of International Settlements, is actually backed by physical. And so now you have a physical contract being backed by, obviously backing a short position. And we're starting to see that process. And I think because what happens is ultimately the EFP is the flywheel. So the EFP, it comes into the EFP if the price gets too low. We see backwardations. We already see anything below 1830. We're seeing massive backwardations, $2.50 even. Anything below 1840, we're also seeing the backwardations. What does that mean? It means that you've got an opportunity to arbitrage the difference between the COMEX price, which is cheaper than the cash price. And so we're starting to see this effect. And without the agent banks there to actually control that flywheel, this flywheel then has two choices. You either allow the Russia, China, BRICS countries, you and I, to go and buy that physical and literally translate that into a physical and take it off the market, or you spin what you can into the ETFs. And currently we're seeing that spin. And we saw Bloomberg come out, I don't know if you saw this yesterday, Bloomberg, exchange-funded traded funds added 923,790 troy ounces of gold. That's 1.07 million ounces since the beginning of the year. Yeah, it didn't go into GLD, mate. So where the hell did that go? That's the question. Where did it go? What do you think?
Yeah, that's I might just mention it aside. We've watched Bitcoin fall this year, and it's had a really tough start to the year, and actually the last 90 days. And I think it's funny. I mean, I own Bitcoin too. I mean, it's not like I'm against it or anything, but all the people have been proponents of it for a decade are like baffled. Well, wait a second. The halving took place and the hash rate is record highs and all these things that used to correlate with higher Bitcoin prices. Why doesn't that work anymore? Well, guess what? The banks have financialized it. Just like gold, they've created all this synthetic Bitcoin now, whether it's in futures contracts or ETFs or all that stuff. So wait a second. Now all of a sudden it's trading like gold, where it's capped and managed. That's a shocking development. So anyway, that's just the way where we are. But like you said, there's a chance now through Basel III that we're finally making some progress in creating, I guess we call it a financial disincentive for the banks to continue with business as usual. You mentioned the EFPs. I remember Eric Sprott telling me in about 2017, he said, "Do you notice this volume of these exchange for physicals, how it's just exploded?" So I've been keeping track of it on a daily basis for 4 years. And there were days before March 2020 when it was like 30,000 contracts being, exchanged for physical, whatever that meant. And then when that all blew up, and the spreads blew out to $100 between spot and the front month, it was like it was a complete destruction of counterparty confidence. I'm not going to short this here because I don't think you're going to be able to deliver metal. And with now the situation in silver again that you referenced with refineries shutting down due to either it's COVID or electricity issues in Europe, we're getting back to that kind of supply tightness again. And I'll give you one more thing, Andy, that has been on my mind. I've been even after last week. If you get into the nuts and bolts, get granular in the Commitment of Traders report, there's a category called swap dealers. Okay, well, what's a swap? Well, what's a swap? A swap is a derivative. Okay, well, what kind of derivative are we talking about? Futures and options. Okay, well, who deals futures and options? The banks. Okay, so why don't we just wipe out swap dealers, a category just called bank trading desks? But anyway, we don't want to make it too clear for everybody what's going on.
Sure.
Well, the swap dealer category in silver is net long silver contracts. Not much, maybe like 1,000 contracts. But that's a very rare occurrence. It doesn't mean silver can't go down on COMEX, but it's pretty unlikely to go down, given that they are net long at these prices. And that's probably a reflection of what's going on with Basel III too, Andy.
Yeah, absolutely. And people think, well, NSFR really that really only really relates to gold, but it doesn't, because every single commodity, and I believe that every single in silver, anyone who trades silver, anyone who trades any commodity is going to have to be compliant. You don't want to roll that stuff onto your balance sheet as a short. And I think these two big to fail banks now are definitely. I mean, once you've got one in, I think we've got certainly every bank that we've spoken to, every European, Swiss bank, every bank that we've spoken to is treating silver as in the same way. And they're looking at all commodities in the same way. You have to.
Well, and Andy, this year becomes about, we might look back a year from now. Maybe this will finally be the year that we kick the legs out from under the stool, of this game. I mentioned Bitcoin being financialized, the way the banks have financialized the precious metals, and really all commodities. But, our main concern is the precious metals. And they've convinced over the last 50 years that, you don't need the actual physical metal. No. You can take exposure to price through these futures contracts or these forward contracts or these ETFs or these unallocated accounts. And they've created all of this, pretend make-believe stuff. And when the time comes, and it could be this year, all the geopolitical events that are going on, this revealing of the Fed and the other central bankers of all being full of crap and that there's no way out besides print, that you combine that with COVID and energy crisis and everything else, maybe this is the year where we finally reach that point of critical mass that we start what is essentially an old-fashioned bank run, where, you keep your money in the local, your local bank. They don't keep your whole deposit on hand there. They don't just put it in the vault. They loan it out, and they might keep 10% of it there for people that want cash that day. And as long as nobody shows up wanting all their cash, everything sails along just fine. It's when, like that scene in It's a Wonderful Life, when everybody shows up at the same time wanting their cash, that this fractional reserve system is revealed, and you get a bank run and a collapse. And that's what we've been waiting for in the precious metals, for as long as I've known you. Can we get to that point where we kick the legs out from under the stool and people demand more physical metal than the system can provide? And you know what? This could easily be the year that does it. I don't know if it will. Eventually, it's going to happen. But with all the different volatility and that's coming up as we go through this year, I don't know. At the end of the day, it just augurs for just getting physical metal, as we've been preaching for as long as I've known you, Andy. That unless you've got physical metal or something like kinesis, you're going to be left holding the bag. And that's why you've got to be paying attention. You've got to know what you're doing if you're going to track the precious metals, and you got to watch shows like yours so you can stay up to date.